Warren Buffett's conglomerate Berkshire Hathaway reported a net loss of $50 billion. Yes, $50 billion after a pandemic swiped the world. This tells us that even the greatest minds in the world of finance aren't insured against unexpected events. And even though the company managed to report a profitable quarter recently, its stock price hasn't even regained itself back to the pre-pandemic levels. Buffett lost his position as the third richest man in the world. Even people like Elon Musk, who seemed quite far away from Buffett's level, have exceeded him. No matter how smart, talented and hardworking you are, the market is very unpredictable, and if you're not careful, you might end up losing everything while thinking that you stumbled on a golden opportunity that will make you a millionaire. While there are endless kinds of mistakes investors usually make, especially for beginners, there are 5 mistakes that most immature investors make, and even sometimes experienced investors can end up losing fortunes. Now, if you don't want to be one of them, if you want your investment to keep growing, if you want to build a fortune in the stock market, then you have to avoid these 5 fundamental mistakes. So listen carefully, because there will be more after this. Hey, welcome back and thank you for sticking around on this channel. Now, if you're brand new, please go ahead and hit that subscribe button if you're interested in learning about things that can elevate you as an individual. Everyone, please ensure that you hit that like button, watch until the very end, and leave your thoughts in the comment section below. Now, let's jump right into today's topic. The first mistake so many people make is really confusing investing with trading. Beginners who just start investing imagine that you have to find a new cool stock to invest in every day or every week. And if you have spent the entire month not investing in a single company, then you are not an investor. In the world of the stock market, there are investors and there are traders. Now listen to this. A trader is someone who buys a stock with intentions to sell on the same day or in the next few days, because the goal isn't to invest but rather to buy the stock and profit from the volatility of the market. Have you ever really seen how fast stock prices move? They jump up and down every single minute, if not every second. The price opens at $100 and closes at $105. So if you trade with $100,000, you can expect to make a $5,000 profit within a day. In theory, it seems like an easy way to make money, but it's much more difficult in practice. Stock prices are almost impossible to predict in the short run, and as a trader, it doesn't matter what stocks you are buying, even if these companies are complete trash, because you're not looking to keep your money there. And that's what makes it so different from investing. Investing means that you're buying tiny pieces of businesses that produce something meaningful, and it grows over time. Naturally, so does the value of your investment. So if there is one company you know that it's doing great, you know where it is going to be in 5 or 10 years from now, you might keep investing in that company instead of reading useless financial reports and wasting your time analyzing unlimited financial statements. The second mistake so many people make is that they are investing emotionally. Whenever a certain asset is rising dramatically, you have tons of people suddenly who get interested in investing, although they didn't give a damn about that stock or asset before. Remember what happened with Bitcoin just a few years ago? The price rose so dramatically that people who had no idea what cryptocurrencies are, who didn't understand how blockchain worked or the technology behind it, they suddenly started buying Bitcoins, hoping that they're going to make a fortune. I am not saying anything negative about Bitcoin, blockchain, or cryptocurrencies, but investing based on your emotions is always a bad idea. Usually, it turns out to be very disastrous, and Bitcoin is just one example. Did you remember the mortgage crisis? Even the most qualified investors could not resist and jumped in. However, the entire thing collapsed, and some countries are still suffering the consequences of that crisis. In the late 1990s, even a giant technology company such as Yahoo made a horrible decision investing a few $1 billion in broadcast.com, which 2 years later they had to shut it down. But Mark Cuban was smart enough to sell his entire stock before everything collapsed. That is a rule of thumb. If it's already in the news and rising dramatically, you missed the opportunity. Accept it and don't feel bad about yourself. By the time you get in, the cycle might be at its peak, and any investment you make should be based on rational, calculated risk. Naturally, of course, you might end up missing some great opportunities, but you will avoid the risk of losing all your wealth and, of course, build a sustainable portfolio over time. The world's greatest investor, Warren Buffett, missed the opportunity to invest in Google, Amazon, and a lot of other great companies. There are two types of stocks worth buying. 1. A stock of a company that has a promising future and its current stock price does actually represent its value today and not 5 or 10 years from now. And secondly, a stock that's for one reason or another undervalued. Everything else probably doesn't worth your money. The third mistake you should avoid is waiting too long to start. Now, investing, like so many things like politics, is all about time. The earlier you invest, the more you are going to earn. $100 invested when you are 20 will turn into $466 by the time you get to 40, while the same $100 invested when you are 30 will turn to just $215 by the time you reach 40. That's assuming if you invest it in an index fund with an annual rate of 8%. I know that you might be thinking that let me wait until I figure everything out, but that time will never come. And why that time will never come, you may ask. There will always be something that you don't know. It might even sound a bit controversial because just a moment ago I warned you not to invest if you don't understand what you are doing. That is true, but you don't have to be a financial genius to start. Remember that. If you are not much into the stock market, invest with an indexed fund. Start with a fraction of your savings or monthly paycheck and then give yourself some time to learn. And once you educate yourself, you can go ahead and invest in companies you believe are going to do better than the S&P 500 in general. I know that you might not have the time, but you don't need to spend hours and hours looking over companies every day. You have to do it once or twice a month. And once you find a good investment, you just keep investing there. My biggest position is in an ETF. I also invest in individual companies, but I am very careful with that because I don't want to spend a ton of my time every day to trade these stocks. The penultimate mistake, not being able to look outside the stock market. Real estate and stock market are the coolest investment, but they are not necessarily the best. My best investments that I have made are all in businesses that I started. The stock market is more to keep my money growing while I am busy growing my businesses. Because if I keep them in a saving account, inflation will eat them out. So I invest in stable companies that have some room for growth. Maximum what you can expect from the market is 7, 8 or at best 10%. Of course, it's different every single year because there were times when SP 500 was higher than 20%, but other times it was down by a -%. But when it comes to a smart investment in a small business that seems to be working, returns can be a few 100% if not thousands. You have the ability and the power to influence it. While when it comes to these multi-billion-dollar corporations, you can't do anything. So don't be blinded by the stock market. The best investment specifically for you might be right under your nose. Now the last mistake I want you to avoid is investing what you can't afford. It is easy to get excited about investing. I get it. You see all these numbers. You want to jump in and nail it so that your bank account gets filled with these green papers, or to be more precise, with those numbers. And that was the case with me as well. But you have to consider other factors as well before you throw your money in. If you need that money in the next few months or so to cover your basic expenses, then it doesn't worth it to invest. Here is why. Since the market is unpredictable, even if it's a huge and stable company, in the long run, it will probably grow. But in the short run, the stock price might fall, and if you suddenly need your money to cover your basic expenses, you might end up selling your investments at a loss. So don't get overexcited. Of course, start as early as possible, but be rational about the amount you want to invest. It's better to start with something smaller, but be consistent, even if that means just a few $100s per month. If you have just started investing or is highly interested, please take these mistakes into account. I don't have any other interest other than helping you by sharing my experiences with it. It is just so painful to lose the money you worked so hard to earn in a blink of an eye. I am not saying that you will never lose anything, because that's a fundamental part of the game, but minimizing your losses and mistakes is a crucial part of success in anything, and that of course includes the stock market. And now it's time to smash that like button if you have enjoyed the video and found it helpful, most importantly. And if you are new around here, make sure to subscribe and turn on your notifications. Thank you for watching, and until the next time, you stay safe, you have been awesome, and I have been Dei-Rasi. Walk good.